Hello everyone, my name is Rohsani. So, in the course of financial management, today we are going to discuss about the determinants of a capital structure. What do we mean by capital structure? Capital structure is the particular combination of debt and equity used by a company to finance its overall operation and growth. Debt comes from in the form of bond issues, loans, while equity may come in the form of common stock, preferred stock, or retained earnings. Right? So debt is a liability for the organization, and equity is the part of company. Like the equity or the shareholders are the owners of the company. Factors of capital structure, basically in the traditional approach, we can see these factors affect the capital structure, like the leverage, cost of capital, government policy, and in the cost of capital we can see the nature of business, size of the organization affects the capital structure, investor requirements, what investor wants also affect the capital structure, and legal requirements, basically legal requirements also affect the capital structure. Nature of business affects a lot, like if the requirement is working capital requirement is more, then we rely on more on working capital rather than on fixed capital. If the our work is of more of a service driven work, then we rely on working capital. Assumptions for trading approach, basically funds come from either equity or debt. Yes, true. 100% profit transferred as dividend. In the traditional approach, we assume that the 100% profit is transferred as dividend to the shareholders. Fixed assets aren't changed over time, the fixed assets remain same. Amount of finance remains constant. Earning before interest and taxes is fixed. Risks are constant, and perpetual longevity, and rational investors. Rationals are always investors are always rational. Net income approach, this is the second approach, and assumptions for the net income approach are no corporate taxes, cost of debt is lesser than the cost of equity, debt usage doesn't change the perception of investors. Value of the firm can be calculated with the help of the following formula, basically where V is the value of the firm, and S is the market value of equity, and B is the market value of debt. So value of the firm is equal to market value of equity plus market value of debt. We have the following formulas of to calculate the cost of basically the capital structure. Net operational income approach, the value can be calculated by earning before interest and taxes is equal to earning before interest and taxes divided by overall cost of capital. Basically this provides the value, and value can also be calculated with the Modigliani and Miller approach, like earning before interest and taxes is equal to earning before interest and taxes 1 minus t over overall cost of capital.